Welcome to another episode of What's on Your Mind, a show hosted by the Institute of Trading and Portfolio Management, where we'll be talking to the Institute's senior trading mentors about what's been on their mind in the financial markets over the last week. I'm Chris Quill, and today I'm joined by David Perlin and Raj Malhotra. Now, just before we jump into the show, I want to remind you guys watching that if you want to learn more about the sort of content that we provide in these episodes and learn more about trading and investing in general, then head over to our website, itpm.com. From there, you'll see a lot of different links to various educational resources, things like our upcoming live seminars, our online courses, bite-sized videos, and mentoring programs that we do around the world as well. So with that being said, let's jump straight back into the show. And David, we'll start with you. What's been on your mind this week?
Good morning, all. Obviously, we're at records again, although there are some, we'll call it disparate forces at work, with the Dow starting to outperform other indices. So I'm watching kind of divergences that might be of note going forward. In particular, 52-week lows exceeding 52-week highs over the last week. The Russell beginning to underperform. For those of us who are not familiar, the Russell is small cap stocks in America. They made a record last in August of August 31st, so it's been a while. But all of this kind of divergence reminds me of what Raj pointed out in one of his earlier sessions, which is groups take turns, sectors take turns leading this market. It's not all about the FANG stocks, and that actually is a healthy extension of the rally we've enjoyed. Obviously, we're on the verge of a very significant earnings season yet again after a record earnings report season last quarter, and that's going to require everybody's attention. Payrolls tomorrow should be a big number, as indicated from yesterday's ADP number. One sector, kind of continuing this theme of rotation, that I've really paid attention to, and that's on my mind this week, is oil. Actually, crude oil is trading at the low 80s in Brent terms and close to that in WTI. Again, explaining the difference, Brent is North Sea crude oil, so that's the oil that gets produced and found and discovered and refined in Europe. WTI is obviously Texas crude, and those are the benchmark world commodity indices for the oil space. What does that mean? Well, obviously, it's an indication of global demand and economic activity. We have very strong economic activity. What else does it mean? It's clear that the Saudis and the Russians are coordinating kind of a response and supply to this rise in oil. Our president is at least tweeting about OPEC manipulating price, but at the same time, he's sanctioned Iran, which is a supplier. So that kind of doesn't make sense. And the other factor of oil going up this much is, in fact, inflation. Inflation playing into the Fed's hand, which is an ongoing rate hike. In fact, yesterday, the 10-year reached a 3.23 yield. So meaningful raise in rates over the last week, which, again, is another thing to watch for in the big picture as far as what could bother this market. I think this oil move has legs, obviously, and a couple ways to play it. We're going to go to Raj, who has some very specific stock ideas. Take it away.
Okay, thanks, David. And first of all, David, sorry to miss you at the conference. And Chris, great seeing you this week. It was one of our best conference ever, with over 200 people, and I'm finally getting my voice back, thankfully. So anyway,
I'll make sure I'm at the next one.
Yeah, please do. So anyway, so back to David's point. Yeah, so and my belief's been for a while that we are kind of in the later stages of a rally. And what I'm saying, and what I've been doing in my portfolio, and what I've been encouraging a lot of my students is to, with your big winners in growth, like names like Twilio, NVIDIA, names that we've been up like 100% plus in. I'm not necessarily saying take it off the table, but we've been doing stock replacement trades. I mean, I still think there could be upside here, but I think it makes sense. We've had big winners to take money off the table. So just selling out longs and buying longer dated calls or call spreads kind of makes sense, given that we could potentially have a move backwards. But having said that, in terms of value, I have been dipping my toe into value names, particularly more in option strategies. And one sector in particular, like you said, was energy. A name that I put on in a pretty big size in my portfolio recently was Halliburton. If you look at a value name, like Halliburton looks cheap, in air quotes, but in terms of but that's in like a metric that I like to use is revenue versus market cap. If you me and one of my students pitched me this like about a month ago. If you look at it, when Halliburton was trading around 37, Halliburton pretty much has a $33 billion market cap and 21 billion in revenue. So if you look at that metric, it's about 1.5 times revenue. So what I did there and what we did was put on a put spread collar. Basically, if you can see this chart up here, we're selling 2 of the 30 puts and buying a 37.5 50 call spread. The belief there is if the stock gets down to 30, you're perfectly fine owning Halliburton. Even if the market does reverse, I feel that the market will rotate into more defensive / names that actually have they have if the market sells off, we're going to stop using electric cars. We're going to stop trying to save the earth. We're going to go back to bare bones economy. So in this trade, we ended up paying, I think, it looks like $1.74 for this, with $12.50 of upside, which is a great risk reward. And I was just looking at it yesterday. It looks like if we unwound the trade today, you could collect $4.50 for the $1.75 you put on. So pretty much 150% plus ROE in 3 weeks. So, and I encourage students to look for names that are of value to look to put that strategy on in names. And we talked about GE in super conferences, one potential, but I really think, especially as you go into Q1, the names that have been beaten down and the so-called value names might have a leg up, and this is a pretty safe way to put this on in a pretty inexpensive way.
Raj, it seems from where I sit that that's what the market's starting to kind of think about with this recent Dow rally, over NASDAQ or over Russell.
Exactly.
So I think you're onto something.
Yeah.
I also want to volunteer an opinion about Raj's options ability to our listening public. Raj has forgotten more about options than I've ever known. So I would pay attention.
I mean, it is a trend. It is a rotation of the old economy, which is good for old guys like me and you.
Yeah, thanks for speaking for me.
So, David, I think you were gonna expand a little bit on rotation of leadership leading on from Raj. Is that right?
Yeah, certainly it's this kind of activity and this kind of market behavior does in fact prolong a rally, because different horses take turns leading this pack, so to speak. And it's pretty clear over the last few weeks that FANG, although still front and center on the screen, is less important in this recent run up, especially in terms of the Dow. In fact, I think it's pretty clear, specifically in looking and analyzing FANG, that the F is basically dead money all of the third quarter. So Facebook has essentially said, we're going to spend so much money on compliance and privacy and figuring out how to protect our clients or our.
It's like Wall Street. It's full market and supervision and compliance on Wall Street and in Silicon Valley now. Yeah,
and it's not, as we live through, not particularly great for ROE for the company. So Facebook's
too, and also bad for PEs. And anytime that becomes that sector, it's no longer a growth. Now it's a heavily regulated sector. The PE.
Yeah, exactly. So Uber growth revenue companies, specifically represented by FANG, is now one letter less. It's ANG. So we'll see what happens. But representative of that feeling about Facebook as an investment, I thought it was eye-opening listening to kind of pull quotes from recent tech conferences, in particular the the Dreamforce conference hosted by Salesforce.com, is Facebook is kind of, they can all kind of lift a leg on Facebook and say that's the bad actor. Tim Cook says I don't collect privacy data, specifically differentiating business models between the companies that collect and use your data and sell it versus what an Apple or even a Salesforce does. So everybody's picking on it. I think it's dead money at best. It's a great way to think about as you build out long short portfolios, again, tying to previous what's on your mind sectors or thoughts. If you think China's on sale and Chinese internet is on sale, why not buy a Baba or a Tencent and short Facebook as a pairs trade? Something to that effect where you're getting exposure that makes sense thematically. So,
what about other sort of sectors that you might think of rotating to within the States?
Well, it's pretty clear that energy was on the back of this crude rally, was a great trade for the third quarter. The other group that makes sense, not only did it kind of peek its head up dramatically and lead the S&P in the third quarter, but also makes thematic sense to me going forward. It kind of reminds me of financial tech or fintech that happened years ago and was a driving force in a kind of a new emerging technology sector, is healthcare. So healthcare had, I think, a 10% return as the broad S&P index for the third quarter. And what's happening in healthcare and healthcare technology in particular is all a result of the gargantuan amount of spending in America for outcomes that aren't as good as other countries. So we spend a ton on healthcare, but we don't have the same effectiveness and efficacy. And obviously, paying for outcomes is going to be the long-term trend for healthcare as opposed to paying for inputs, which means if you're healthier after being treated, that doctor and that hospital system will get paid more. And to do all of that requires a lot of technology in addressing what's going on with patient populations, the environmental impacts on those populations, and then the outcomes to their health and healthcare thereof. And also there's specific technologies that are being developed to measure all of this. Huge data compilation. So the incumbent data companies kind of do things in giant databases and kind of the old way. But the new disruptive technologies, that's a sector that I'm spending a lot of time in. And I know for a fact that Raj has done a lot of work in biotech, which is a volatile sector on a regular day, and somewhat binary sometimes because drugs get approved or not approved. But there are ways, those are the kind of things that set up when those kind of binary outcomes happen, they're perfectly set up for kind of an options approach. So I'll let Raj to layer in his options genius to this.
Okay. Well, let's say that one thing. David's not only into healthcare because all of his wealthy neighbors are lobbyists for very rich healthcare firms. And if you don't know, David lives in D.C., so he's surrounded by lobbyists. So I promise he's getting no kickbacks for this.
I'm trying not to be a lobbyist. I really am.
But David does make a good point about healthcare. One thing about healthcare is I can tell a personal story. So I went to the doctor last week, and he looked at me. He did all the tests, and he said, "You're in perfect health. Whatever you're doing, keep doing." So obviously that means the healthcare system is broken in this country. He thinks that I'm in perfect health. But go back to his point. In all seriousness, healthcare. There's no doubt, obviously, that healthcare is it's in a bull market and will continue to be in a bull market because I think that's one thing. Everyone seems to be in favor of less expensive healthcare, less healthcare, except if it's for your own. Similar to taxes where everybody thinks tax should be higher except for yourself. So having said that, thematically, it's an easy thing to say, let's cut healthcare costs. Let's do less invasive technologies. Let's do less tests, unless it's for you or your loved ones. So that becomes a hard thing to lower costs and care, really. Like they said, nobody wants to pull the plug on granny. Well, that's very thematically, healthcare is the biggest problem with the cost of healthcare is the fact that the U.S. has 330 million people, but that people live an average of 15 years longer than they used to. So do the math. And most 90+% of the amount spent is at the end of life. So that's really not. There's no way to really fix that problem. Having said that, in terms of like names and to be looking at, disruptive technologies, like you said, in healthcare are the way that I like to play this sector. Names I've been in are like Dexcom, DXCM, TDoc. Dexcom basically provides diabetes management system, a system that before I think you just have to just have a needle around and look like a heroin addict. Now these guys actually provide better health services for that. TDoc, basically a company that uses telephone and video conferencing technology to provide remote healthcare via like the internet and your phone. So those kind of disruptive technologies are, and then that technology basically replaces your doctor. So I feel like you should be looking on the lookout for those type of names in your portfolio, which are going to essentially change the healthcare system. And another problem with healthcare now is just there are not enough doctors or enough qualified doctors, because you don't get paid as much as you used to. Like I would never, like you want to be a doctor, spend 10 years in medical school, and then get told by the government you're not going to get paid anything. And really the doctors that make money now are plastic surgery, anything elective. But outside of the real doctors, the ones that are actually helping you, they just don't make the money that they used to. And with all the red tape you have to go through, why would anyone that's intelligent want to be a doctor? They talk about how you're supposed to be it's a life calling. Well, that's bullshit. So, but having said that, in those names that I've been talking about, or these healthcare disruptive technologies, I still think, like David said, these names have a lot of volatility. I encourage you to have smaller position sizes in these names as opposed to a name with normal volatility, or just trade options in them, because, like you said, one bad headline, one bad drug can take a company down 50, 60, 80%. So it can be a dangerous game, but with played right and played smart, there are big potential returns in this space, in the disruptive healthcare space.
Do you find that with stocks in biotech, because they're essentially or could be very volatile, that option prices tend to be relatively high, or is that not an issue?
Well, I mean, of course it is. I mean, market makers aren't stupid. Like, market makers don't necessarily want to, put their neck out. But the advantage actually for a retail investor or for institutions, and I can say this from experience, when these healthcare funds want to come trade options, the last thing you want to do is sell 5,000 or 10,000 options on a name that could gap up 50%. But if we're buying 3 to 4 options, like, they exist now. There is liquidity for that size. Now, again, you pay for it, but if you're smart, you can. There are returns to be made. But having said it, Chris, you're right. They are expensive, and they're expensive for a reason. But again, like I've said before, whether it's in mentors or in conferences, when vol is high, it's high for a reason. And you rather don't confuse being something high with being expensive.
So David, let's switch back to you. I think you had a couple of thoughts to build on in terms of some other themes and relevant sort of news. So you're thinking about looking at cannabis stocks and things like that. Is that correct?
So that's disruptive healthcare for sure, right there.
Exactly. I think we're connecting an interesting emerging technology, if you will, with healthcare. As many of our viewers know, cannabis is not legal in the United States on the federal level, and it's probably not going to change in the near future given the administration that's currently in charge of this. That being said, they've pretty much let the states do, in a populist voting sense, their own thing, so to speak, as far as whether they legalize medical marijuana or recreational in a handful of states. But because of the federal rules, there are very few investable stocks to play in. Canada has already approved on a national level and is actually embarking on full rollout and a new regulatory regime for all their cannabis needs and desires. So north of the border, there are many options in stocks. Well, at least a handful. And even though they have a much lower population, it's not that big a business. Constellation Brands, which is one of the largest diversified alcohol companies in the world, has spent $4 billion on a slightly less than 50% stake in a company called Canopy up in Canada. So that happened a couple of months ago, and that was kind of eye-opening to the investing world as far as here's a company that clearly sees cannabis or marijuana as a threat to their alcohol business. And they're looking out, 10, 20 years when cannabis is as readily available as a beer or a glass of wine is. And they want that optionality so that their market that they're addressing is as big as it is now or bigger. So that's a huge bet, and that kind of investment really shined a light on the possibility of this growing up and becoming a real industry. So you've got the medical take on it. So everybody that watches CNBC at all during the day has been watching a company called Tilray, which is a U.S. listed TLRY, U.S. listed medical marijuana company. That stock has been trading kind of like Bitcoin was trading in kind of December and January. Huge up and down moves of 20, 25% per day. On any kind of headlines about endorsement, just this week, rumors that Pepsi was looking at cannabis as an ingredient in the future for some of their soft drinks. Denial by the CFO, stock goes down. So you're going to see a lot more of this kind of binary kind of response to news. But I think that to put this on a watch list, as far as this is an emerging market that's difficult to invest in, but compared to crypto, which is difficult to do financial analysis on, we have companies with reported earnings or losses and revenues. We can do financial modeling and get to valuations that might make sense.
Yeah, I guess my take on that is, number one, kind of relating to the crypto thing. I think that a lot of the millennials that are just trading these things have no idea how any of these things trade. We actually moved from crypto to trading Tilray and other pot stocks. So I think that actually has a ton to do with the volatility. But you're right that there's not a lot of what the similarities are. There was not a lot of investable stocks. So for Tilray to trade at the valuation that did at its peak was insanity. Now, having said that, you're absolutely right. And going back to this Constellation Brands acquisition, I mean, remember the day of, the market clearly didn't like that. And I know a little bit about Constellation Brands. They actually the CEO actually owns my golf course in Florida. So the thought, I think, in their mind is that pot one day is almost like an additive to their general business. It's not necessarily competing with it, but it's also like, okay, you can buy pot and alcohol at one place or one, obviously it caters, well, weed is a gateway drug. So that way, they're completing the whole bridge of products for the addict. So that's it. So that's that. But I think when going back to the watch list in terms of investable news, the one news that you can, if you get this piece of news, you write this down. If you get this bit of news, ever comes out, the stocks will all be up 50%. Or if, like David said, it's not legal right now around the country. And the biggest issue that the pot growers have in Colorado and Washington are that, not the pot growers, the pot businesses, is that they're not allowed to bank. They're not allowed to put their money in the bank because it violates interstate commerce laws. So meaning, like, even if you're a Colorado resident, if you have a credit card from Citibank, that's domiciled in South Dakota. So that breaks interstate commerce law because it's not legal in South Dakota, but it is in Colorado. Even if you're a resident, it goes to one state and back to the other state. So if they ever figure out that legislation to make that legal, which it should be, because it's legal, and using it creates a lot of, if you've never been to Colorado, it creates a lot of security issues, because these companies have to hold all their money in cash in a vault, hire a security guard, pay for their electricity bill in cash. It becomes such a problem not being able to bank. If you're ever able to bank legally in that business, those stocks are up a ton. And that's really that's the one headline to put on your watch list to look for. Any legislation move forward towards that.
All right, well, I think that's all we have time for on this week's episode of What's on Your Mind. Raj, David, thank you for joining me on the episode, and I look forward to catching up with you guys next time. As for you guys watching, I just want to remind you that if you want to learn more about the sort of content that we covered in this episode and others, learn more about trading and investing in general, then do visit our website, itpm.com. We've got a bunch of different educational resources up there, so things like our live upcoming seminars, our online video education, bite-sized videos, and mentoring programs that we do around the world. And those are with guys just like David and Raj who can really help you excel as a trader. So that's all from us. I hope you enjoyed the episode, and make sure you join us next time for another episode of What's on Your Mind.